All right, let me just talk to you about the broader market. I mean, it's very important to note out the NASDAQ and the S&P, they're both at record highs, double-digit record highs this year so far. So is the concern about tariffs in the market, has it maybe been overblown?
I don't think so. If you take out technology and communication sectors out of the S&P, earnings are only up less than 1% so far, with revenue growth at about 3%, which is in line with nominal GDP, give or take. So I don't think this is overblown at all. In the last CPI number, the core goods prices on items that we specifically import, you saw annualized gains in just 1 month. So I don't think so at all, and I think this still has months to play out. And while I think it's good that we're finally coming to some deals and we can end this whole tariff thing in terms of what the eventual rates will be, but we still have to deal with the highest tariff rates in more than 100 years.
All right, so let's get to the market consequences. I think a lot of people understand the economic consequences. We've seen a lot of estimates for GDP be reduced. A lot of people believe that we may even face stagflation, with inflation ticking up very slightly and growth slowing down as well. But what are the market implications? We've seen companies like GM see their profits lower. We've seen a lot of companies reduce their guidance. Do we start to see this impact in the back half of the year?
So GDP growth in the first half of this year, if the Atlanta Fed is right, that Q2 growth will be about 2.5%. That's 1% annualized first half growth. If these tariffs have more room to flow through the economy, there is risk that the second half of the year will be less than 1%. And it's hard to generate both top and bottom line earnings growth when GDP growth is growing so anemically. And again, big cap tech are leading the earnings, but outside of that, there's very little earnings growth. Stock market, of course, is very optimistic that this is going to be all overblown and we're overreacting to tariffs. But I'm a fan of low taxes, not higher ones.
Right. So you're basically saying that this is essentially a consumption tax. Even though we lowered the income tax with the spending and tax bill, this is a consumption tax that's being paid either by the producers or the consumers, or maybe just a combination of both. As we look at some of the companies reducing their guidance, I would imagine that would also reduce earnings estimates. What does that mean for the market if we see lower estimates? A lot of times, like this quarter, for example, the estimate's 5.7. We're at 7.7. That seems to be one of the tailwinds. If the estimates get lower, does that reduce the ability of the market to climb higher, even if companies beat?
Well, almost all of that earnings growth is being led by two sectors. The rest of the S&P is not seeing any earnings growth, and actually about half the S&P is seeing declines in earnings growth. So you need to continue to see, from an index standpoint, dominance in that big cap tech, because outside of that, earnings growth is more reflective of nominal GDP growth, which is pretty muted right now. So all basically we're seeing, Frank, is just another expansion in the PE multiple. I mean, just for context, in March 2000, the forward 12-month PE ratio was about 24.5 times. Now we're about 23 times forward. So you're stretching the limits of historical sort of valuation metrics, and we're in rarefied air. Now, this is not a market call. We can stay elevated for a long time, but I think that people should understand what's really driving this, and it's just a few sectors with very limited contribution from others.